Welcome.
Sara, a real pleasure to be here. Thank you.
When we spoke just a couple of weeks ago to get ready for this topic, gold was sitting at about $3,500. I just want to point out that was 2 weeks ago.
Yeah.
Where is it today?
Well, last time I checked, it's well over 4,200 and continuing. It took a little pause on Friday and early Monday, but today it's on its way back up again and still continuing this strong trend.
And where do you think it could hit?
Well, I've been pretty public about the fact that it wouldn't surprise me to see $5,000 before the end of next year. I'm starting to think that might happen by the end of this year now. And I don't have any problem envisioning it being at about $10,000 an ounce before the end of the decade here, 2030. And so, what we're seeing is continued concern about the measuring stick. And it's not so much my confidence on gold, it's my lack of confidence on the U.S. dollar, which is the measuring stick that we're using to measure gold and to measure so many other assets, hard assets. The only way the United States works its way through the debt challenges that they have is to dramatically devalue that currency. And I think a lot of the world is waking up to that realization, and that's what's driving gold right now. And even more impressively, late silver at the same time is also getting a bit of a ride along that. So it's been a pretty incredible last couple of months in terms of that momentum into precious metals.
So as we talk about this, I think there's a lot of interest in getting into the space, but then there's anxiety about how to do it. And that is where Wheaton offers something of an advantage. You have a streaming model. Now, this is a very sophisticated audience, but nevertheless, can we pull back and just explain what you do with that streaming model and what makes it appealing?
Well, I'm gonna go back and put myself. I'm a geological engineer that was working in project development, operated a couple of mines in northern Canada in my time, and was working with a company called Goldcorp, which has since been swallowed up by Newmont. But back in the day, 20 some odd years ago, we were trying to build a gold company, and we needed capital to build that company. And we had a bunch of non-core byproduct silver production within our gold company. And so we came up with a concept 21 years ago about streaming. We were the first company that came up with this concept. And it's to take that non-core byproduct and crystallize the value of that on a go-forward basis and help to use that value to continue to grow our core franchise, which is the gold space, the gold mining company. And the creation of the original silver Wheaton, which is now Wheaton Precious Metals, and I'm now the CEO of. But that initial creation created billions of dollars of value to help. It was probably the largest single contributor in terms of building Goldcorp into the company that it ultimately turned into, especially at its peak, ultimately swallowed up by Newmont probably about 10 years ago now. Silver Wheaton has since morphed into Wheaton Precious Metals, and we stream byproduct, sometimes non-core byproduct metals off of operators. And for that, we pay a large amount of money up front, typically during the construction process. And for that, we get the right to a portion of that metal production with some parameters in terms of fixed costs. And so the advantage for us and our investors is that we're taking the cost risk out of a traditional mining investment. But because it's a percentage of that metal, we're truly an equity partner in these assets. We also get the benefits if we choose wisely. And that's one of the key tricks to being successful in this business, is obviously picking the right assets to invest into. And if we choose wisely, we get to share that exploration success and that expansion potential, and also, obviously, the commodity price exposure with our shareholders. In fact, levered exposure without the same cost risk. Our capital costs are the acquisition cost, and our operating costs are defined in the contract at a fixed rate on a per ounce basis going forward. So taking that cost risk out of the investment. From the operator's perspective, and just listening to the previous guests speak about the importance of copper. Just about every copper mine in this world produces a bit of byproduct precious metals, a little bit of gold, a little bit of silver. Over 70% of our revenue actually comes from copper mines. So we are one of the biggest financiers in the copper space in terms of trying to grow that copper space, because what we do is we come in and buy that non-core precious metals byproduct from these copper mines. And typically, I'll give you an example, Vale's Salobo mine, one of the most incredible, profitable copper gold mines in the world in northern Brazil. We supplied over 80% of the capital to get that mine built. and we only take away a little bit less than 20% of the revenue. So for the operator's perspective, a very attractive way to bring in an equity partner that over-contributes its share of the construction costs, dramatically improves the return on invested capital for the operator, and makes it a real win-win situation, which is the only way we're going to go forward, is if it works for us and it works for the operator. So it's a very unique financing model that has really blossomed. We've now contributed well over $10 billion towards a lot of that to the copper industry, but to other industries, and continuing to grow very rapidly.
So you mentioned one project. I was thinking about the one with Artemis Gold, the Blackwater project. That's an example. You call this gold on steroids. Can you just give us a minute or two on why that project is so successful?
Well, so Artemis is a small single asset company. Their project is called the Blackwater Project. It's now up and running. They started production earlier on this year. They've been in construction for the last 2 years. We supplied over $500 million in capital towards getting this mine built, which was probably around 50 or 60% of the total capital required to get this built. And for that, we take away 8% of the gold production. This one's a bit unique because we usually, as I said earlier on, most of our production is non-core byproduct. But to be honest, the streaming model as a financing mechanism to help build mines is even so attractive that what we're now seeing is gold companies do gold streams to help finance their construction. And Artemis is a great example of that, where we contributed over $500 million towards the construction of that mine, which of course dramatically reduced their own obligations, the dilution that their shareholders had to go through, and reduce the amount of debt that they require. It's now up and running. We take away about 8% of the gold from that mine, and I think 50% of the silver. It's not much silver. Most of the value is in gold at this mine. And it's a real win-win situation. The beauty of Artemis and the track record, and the reason why I wanted that one highlighted, is because they, like a lot of construction projects, got a little bit capital constrained towards the tail end of that construction period. Needed to raise a little bit more capital. We all know what the bank says when you call them up on something like that. We also know what the equity markets say if they know that you're going to be a little bit short on capital. That's when you start getting people trying to play on ARBs and such like that. But a supportive equity partner like Wheaton, we increased that by $70 million over 2 different tranches to get them over the line. So they're now producing, and the mine is now actually running beautifully. We just took 30 investors and analysts up to the mine site 2 weeks ago. It was a fantastic tour. Great operation, a huge success story. This is why streaming works.
So you talk about also the need to go into new areas, and one of those is Australia. So I understand that you've done more investing here in the last 2 years than in the 20 years before that, which is a dramatic uptake. Why is Australia suddenly so appealing? I mean, it's a great place, but why?
It is a fantastic place. So keep in mind that we spent the first 10 years focused on silver. There's not a lot of silver in Australia. Most silver comes Mexico, Peru, the Latin American stretch all the way through there. So we really spent most of our time focused there. I did come down and have a good look at Cannington, one of the best silver producers in its time, and so had been there, and I know there's some stuff out of Tasmania and such, but the shift into gold, when I took over as CEO back in 2011, we started focusing on broader precious metals just because the silver space isn't big enough. There's not enough opportunity for where we wanted to grow as a company in the silver space. And so we're now more focused on gold, which of course really opens up Australia, one of the better gold jurisdictions in the world. For a long time, the superannuation funds were forced to reinvest back into Australia, which meant that there was an abundance of capital here looking for places to invest, and we were competing. We supply capital. We were competing against that, and it really made it tough to get traction into Australia. The other aspect I would say is that Australians understand resources probably better than, I'm going to say, or as good as any culture around the world. And they understand the benefits of longevity and the value of a long-term resource. And so, so they treat a streaming transaction with a little bit more caution than what we've seen in other parts of the world, because these are life of mine agreements. We're an equity partner. We invest into these assets, and we ride that wave, whether it's good or bad, for the life of the mine on a go-forward basis. And Australians have always been a little bit more cautious about that longevity. As I say, they have a bit more respect for the value of a resource, even if it's 20, 30, 40 years out. And so it's kind of, held it back. We have recently made our first investment into Australia, a small little royalty transaction that it gives us a ROFR. We are focused on streaming. We think streaming is the best way to deliver value, not only to our shareholders, but also to our operating partners. But having a small royalty with a right of first refusal on subsequent financing mechanisms allows us an opportunity to deliver that in. I can tell you we currently have corp dev teams here in Australia looking at assets, and you're right, in the last couple of years, probably the last 3 years, we've had more visits to Australia looking at projects. Not every project is going to be a Wheaton project. We're very, very disciplined about technical due diligence and technical excellence, and we are very selective about the partners and more specifically the projects that we invest into. But there's definitely opportunity here in Australia, and you will see our name more here.
So you touched upon super funds, and that has really changed. I mean, I've talked to people in super funds who actually have a little more caution regarding some things in the U.S. related to the tariff picture. Does that open up opportunities for Wheaton? Where does that land you all?
Well, definitely. From an investing perspective, I spent yesterday down in Melbourne meeting with a lot of the funds, and I'm spending tomorrow here in Sydney outside of the conference meeting with, again, a lot of the fund representatives and such. Our business model is one that's quite attractive, especially in today's world, where you're seeing a lot of very respected worldwide money managers highly recommend that you dramatically increase, most of the numbers I've seen are 10 to 15% of your personal portfolio should be gold exposed in one way or another. Wheaton presents a very low-risk way for people, for investors to invest into gold that still delivers the upside of the traditional mining, a good mining investment, which has exploration success and expansion potential and commodity price exposure. But we do it with such a low risk profile, with the lack of cost risk, with the fact that how much our costs are going to be. It's prescribed in our contracts and spelled out over the life of the mine. You know what our capital costs are. That's the dollars that we put up front to earn the contract itself. And so the appetite that we are seeing down here is now that the super funds are allowed to invest more globally, there's a very healthy interest in a company like ours to increase their own precious metals exposure.
Pulling back a little bit, there's a lot of resource nationalism going on right now. How does that affect you?
Well, I did spend 3 years as the chair of the World Gold Council, finished that off a couple of years ago. And so I was representing the gold industry at a lot of the different COP conferences. And one of the arguments that I've always had, and Australia scores very well on this, but I really do think that a lot of communities and cultures and countries around the world should be rated on how much they consume versus how much they contribute. Because nobody wants a mine in their backyard, but someone has to have a mine in their backyard. And so I was arguing for that at the numerous COP conferences, in the sense that I think it's time for cultures and for communities and countries to start thinking about the fact that earlier on today I saw a representative from Europe up on the stage here talking about investing into the mining industry. Europe is not a jurisdiction that has been very supportive of extractive resources, of supporting responsibly extractive resources. And that needs to be measured up. Now, one of the side effects, I think, of the deglobalization that's coming with all this tariff talk is that it's causing countries to now start and think about being a little bit more self-sufficient. And I think that's something that is necessary. We're a Canadian company, and I can tell you that even in Canada, all of a sudden the resource industry is being held up as that's how we're going to save the country, and that's how we're going to help the country stand on its own 2 feet. Canada has long suffered from being the little brother hiding behind its big brother right next door, and we tend to rely so heavily on the United States to take care of us that we haven't built that independence. And we're now seeing a lot more rhetoric. I'd love to see concrete action. There's a lot of rhetoric in that space. I think it does bode well, especially for the resource industry. That being said, when it comes to resources, I do think that there's a measure of globalization that should be required, just to make sure that we don't encourage inefficiencies in certain jurisdictions because of these boundaries.
All right. As we wrap up, I'm going to give you just a couple seconds. Wheaton philosophy in one line to wrap us up.
We've always focused on high quality and precious metals. We're essentially a pure precious metals company, 65% gold revenue, 35% silver revenue. That silver is looking more and more attractive all the time. It's the silver market is going through a really interesting market right now where we're just not seeing demand. We're not seeing the supply come in. The demand is climbing, and we're not seeing that demand satisfied. The vaults are empty. We've been running in deficit for silver for a long time, so that exposure has been very good. But we are dominantly a gold company. We are here to help companies build projects, and our source of capital is a very attractive source of capital, especially compared to diluting excessively your existing shareholders. Let's never forget, we work for existing shareholders, not the ones you're selling to in the future. And so we're here to help build this industry.
Well, very much appreciate the conversation and the look under the hood at the streaming model and how it's transforming this sector. A big round of applause, please, for
Thank you, Sara.
Randy Smallwood.
Thank you, everyone.